A very warm welcome to everyone to the session of Excelsior 2021 Inside Investors' Mind. I, Shravani Gulhane.
And I, EDCVIIT, got this opportunity to be present as the host for today's session. Let's learn something new today as knowledge gets the work done. Be with us throughout the session and good afternoon to everyone.
You know that the patient is in the safe hands when the doctor is an investor too. So, following this quote, we have with us an all rounder personality, an IVF specialist, graduated from Bombay University with 20 shining gold medals, author to innovative books like How to Find the Best Doctor.
And so now we welcome Dr. Aniruddha Malpani, the guest for today's session. He is a passionate personality who believes in patient empowerment and thinks that IT and medicine can work together as a health boom.
As Dr. Malpani thinks, when going through failures, make books your friends. And he manifested this thought by founding the world's largest free patient education library named Help, which is also world's largest free library on customer health information in the Limca Book of Records.
As founder and director of Malpani Ventures, Dr. Malpani quotes that when entrepreneurs help one another without expecting anything in return, good things are ought to happen. And staying true to this, he is an active angel investor and provides investment to young and aspiring minds. He has invested in renowned companies like Bbox and Plus 91.
He is also very concerned about the education system and often tries to make change. We are very lucky to have such a versatile personality with us sharing his thoughts here today. So now we hand over the platform to Dr. Malpani, sir.
Yes, sir, please take over.
Okay, I'll do that. Good morning, guys. I loved listening to, I cannot start screen share while the other participant is sharing. So is there any way I can start now? I loved listening to Manaf, lots of inspiration and excitement. Can you guys see? One sec. Can you see this?
Yes, sir.
Okay, and is it full screen now?
Not yet, sir.
Is this better?
Yep, sure, sir.
The great thing about being an investor is everyone is very nice to you because obviously everyone wants you to sign a check for them. But today I'm going to tell you a few hard truths. And part of the problem, I think, with the startup ecosystem is everyone gets information which I think is actually very misleading because you often get information about the success stories, about people like Munaf who've done such a great job, or you read all the press releases which the VCs send out. But the reality is a lot of these are actually embellishments. They are distortions of the truth. And that's often not the way real life works. This, of course, is, you guys are young. The whole world is ahead of you. Lots of new opportunities. Hum kisi se kam nahi hai. Of course, we can do everything these guys in Silicon Valley can do. Actually, we're much smarter and brighter and hardworking. And India is the land of opportunities, right? I don't know how many of you guys have this poster of Superman in your room, but that's the way most of us think of ourselves when you're 20, 25. All these older guys are dinosaurs, they're idiots, they don't understand basic stuff. We know so much more, everything is outdated, and I'm going to change the world. And all these stories about Steve Jobs and Elon Musk and the hard thing about hard things are extremely inspirational, no question about that. All you require is what? You have the brains, you're willing to put in the hard work. You just need someone to give you a little bit of money and then you're on your way, correct? Fair enough, simple enough. And there's no shortage of investors based on what you've read in the, the press or the books you read and stuff about how an angel comes to your rescue and helps you convert your dreams into reality. And this, of course, is what people think the formula is. You have this great idea. You create a business plan, and there are lots of websites and lots of books and lots of people who will create these business plans for you if you get the money and pay them. And then you combine the business plan with money from an investor, you make your product and you're going to become a millionaire. So why bother to work at a place like Google when you can make your own money for yourself? Unfortunately, this is the commonest word which an entrepreneur hears. You'll hear a no from investors. Well, actually, you'll start hearing no from your parents, as Munaf said. The first thing your parents will say, what? You're an idiot? Why can't you work for a job properly? Why don't you settle down? Why don't you get married? Why don't you do this, falana, dikana? There's always something they want you to do. And everyone thinks of entrepreneurship as being very risky, and they're not convinced that you have the right to win. And imagine if you can't even convince your parents that you're going to be a great entrepreneur, why do you think you're going to be able to convince an investor to be able to do that? So this is the commonest. And the no just doesn't come from investors. Like I said, it comes from parents, it comes from family members, it comes from your friends who will say, Arey, so much easier to work for a job. We can always do the entrepreneurship later on. You try looking for co-founders, you try looking for employees to hire. Standard answer, no. You look for customers. Again, no, it's too risky, it's too expensive. We're happy to do it only if you give us a free trial. So you keep on hearing no all the time. And every no you hear should actually make you stronger. And then instead of Superman, this is actually the way you start thinking of yourself, like a little baby in the swimming pool, the deep end, and all you have is floats to keep you alive. So let's start from the beginning. But there's one question I want to ask you guys. The trouble with asking you guys questions on Zoom is it's very hard to get answers. And that's the great thing about a live event, because I can stop, I can ask questions. But one question I need to ask, two questions actually. Hey, how many of you guys have your own personal websites? And it actually bothers me when Indian college students don't have their own website. This is your most important piece of digital real estate. This is your resume, which is going to be an important part of the rest of your world. This is true if you become an entrepreneur, because the first thing an investor does is going to Google you. And if you find your personal website, which shows us all the various things you've accomplished during your life, that's very impressive. And that's going to be true even if you apply for a job, because recruiters are going to check. And far better than just having a page on LinkedIn, because the trouble with LinkedIn is then you're competing with thousands of other guys who want the same job. Whereas if it's your own personal website, it's completely in your control. And the second question I want to ask is, how many of you guys are actually tweeting while you're listening? And that again disappoints me. You've got to position yourself as being an expert, someone who understands, someone who's out there, someone who's willing to share knowledge. And it's so easy and it's so free to do this. So guys, please go ahead and listen to the lecture, but please keep a smartphone in your hand and please tweet frequently. Let the world know what you're learning, because that's a great way of positioning yourself. Hey, I'm well informed, I'm interested, I'm trying to improve myself. And more importantly, I'm happy to learn and I'm happy to teach other people. Okay, so you have this great idea and now you want money. So where do you get the money? And if you look at this list, you will realize that investors is actually very, very low down. There are lots of other sources. So the first is, for example, you could easily do a job and this could be a side hustle. Or if you're qualified, you could do a consultancy and earn money from that. Bootstrapping is what I actually advise. I tell everyone, investors are optional. Investors can't do anything without entrepreneurs, but entrepreneurs don't always need investors. And the best way to bootstrap means you get your customers to pay you. And trust me, if your customers will pay you, investors will line up to give you money. Of course, you can raise money from family and friends. You can arm twist them and cajole them, but be careful. Because if, God forbid, and there's a very high probability you will fail, you don't want to end up looking embarrassed and saying, sorry, I can't return your money, because that actually ruins family relationships. As I said, customer funding is the best. There are other options like crowdfunding and ICOs. And of course, there are angels and VCs, and I'm going to be talking about that. But the important thing is, for the right entrepreneur, there is really no shortage of money. So I hate it when entrepreneurs feel sorry for themselves and say, oh, no one is willing to give us money. We have the money. We want to give money to people because we want you guys to multiply our money. It's just that we're not convinced that you're the right person. So you need to work a little bit harder at this. Who can you raise money from? There is a right time and a right place. So just because you have an idea doesn't mean you can go to a VC and ask for money. If it's very early stage, which is your idea, please start off with bootstrapping your own personal friends. If you've managed to put a team together, which is very important because that shows that your friends and co-founders are convinced and they're willing to join you in your dream, then you can approach family members. If you're doing projects, for example, biotech or healthcare or in social impact, you will often get public support in the form of grants. It's not easy to get money from grants. It appears to be free money, but there's so much paperwork and so many forms, and it just takes forever and ever, but it's just important to remember that's a source. Once you keep on maturing, you've got a prototype, you can then go to accelerators and incubators. You can go to angels. And once you've reached a particular point, started getting revenue, and you want to start growing, you can actually go to VCs. And once your bank manager is convinced that you're a safe bet, banks are actually the cheapest source of capital. Let me explain some of this. And what you can't control is whether people will give you money or not. That's not in your control. But what you can control is the gray line. You can move as quickly as possible from the idea to putting a team together. And your team could be just you and lots of freelancers. You could create a prototype as quickly as possible. This is the MVP, not a minimal viable product, but a minimal viable prototype, which you can release and share with the world. Launch it as quickly as possible. Please, imperfection is fine. Perfection is actually your enemy, because it's only when users give you feedback that you'll be able to improve your prototype. Then, of course, once you release it, you'll start getting users. They are the best source of revenue. And once you get satisfied paying customers who will act as brand ambassadors and refer their friends to you, you will then start making more money and grow. And finally, at some point, you'll start making profits. The reason bootstrapping is important is because ideas are a dime a dozen. No one is going to fund ideas unless it's your father-in-law and he happens to be very rich. Bootstrapping proves that you can implement. And honestly, it shows that you have faith in yourself, that you're willing to put skin in the game, that you're willing to stick your neck out. You're not willing to settle for a cushy job, because we see so many wannabe entrepreneurs who keep on talking about ideas. Oh, I'm going to do this and I'm going to do that. But they're scared to leave their job because, oh, I have a family responsibility. I have a mortgage to pay. I have to buy a new car. I have to pay my kids' fees. There are always 50 reasons why it's too risky to become an entrepreneur. But if you can bootstrap, it shows you have faith in yourself. And if you're not willing to invest in yourself, why do you expect me to? Guerrilla marketing. This means don't waste money on ads. It's extremely expensive. It's great for Google shareholders, but it's definitely not great for you. And remember, your customers are your best source of funding. And if you can get customers to fund you, you'll definitely get investors. This is the story in the US. It's very, very different in India. But even in the US, please remember that venture capital and angel investors are still a very, very small proportion. Most of it still comes from personal funds and family and friends. And in India, that proportion is much, much higher. Family and friends are easy to tap into, but lots of people make lots of mistakes when they do this. So don't take money from someone who doesn't understand how risky a startup is. Because every time, every 15 days, they'll ask you, hey, when are you giving my money back? How are you doing? They'll expect instant results. And that's just not happening. You need to explain to them that this is money which for all practical purposes is going to be locked up at least for 5 to 10 years. Don't take money from someone who can't afford to lose it, because then that will give you sleepless nights, and that's hard. Taking the money as a loan, perhaps, but there's a high probability you won't be able to repay the loan. And a lot of people give you the loan and say, oh yeah, here's 10 lakhs. I want 50% of your company. And you're so desperate and you say, anyway, my company is worthless. So why not go ahead and give it? Something is better than nothing. And this will come back to haunt you, especially if your company becomes successful, because effectively you've given it away for a song. And that's not great. Ideas, implementation, and funding. And like I said, don't fall in love with your ideas, please, because most of your ideas are bad. And here's a suggestion. Keep a diary of all your ideas and then look back at your ideas 2 years from now and you'll say, God, what an idiot I was. I actually thought that would work. Generate lots of ideas. The more the ideas you generate, the better you will have of finding the right one. This is one instance where quality is actually proportional to quantity. The commonest problem we find is people will refuse to share because they're scared that someone will steal your idea. Oh, all these angel investors and VCs are all crooked. They will steal my idea and then give it to their nephew or their niece or their son or someone else who will then run the company. And then I will be left with nothing. Forget it. Incidentally, if anyone wants any ideas, please ask me. I'm happy to share them for free. The important thing about sharing ideas, especially on a public platform, is that you can actually ask for criticism and polish them. And everyone hears about how passion is important. Passion is necessary, but passion won't help you go through sleepless nights, won't help you pay your bills. So it's definitely not sufficient. This is what people think angel investors and VCs look like. But the truth again is that it's not hard to find investors, but it's not easy either. So lots of ways of doing it. And email also is absolutely fine because every reliable investor has their own website, has an email address. We're always looking for deal flow. We're always looking for entrepreneurs to fund. It's just that there's a high probability that you won't be the right one, which is why we reject 99%. LinkedIn works well, Twitter works well. Most people have social media accounts. You can always follow them for a long time and make intelligent comments on their posts, which kind of, so at least your name starts becoming familiar. The best way, of course, is to get a warm introduction. What does that mean? To find a friend or a family member or an alumnus from your college to introduce you. And this is great because we're much more likely to respond to your pitch if you go through a warm introduction, because it shows that you've taken the time and the trouble to find someone who knows us. And hopefully that person will help you polish your pitch and tell you what interests us. It's useful to establish yourself as a thought leader. And that's why I said, tweet frequently, post on social media, create your own website, because it gives you a chance to explain how much you know about your own domain. You can establish yourself as a thought leader. So it's like, oh, this guy knows a lot about, let's say, EV or AI or ML or Bitcoin or whatever. And then investors will respect you for your knowledge. Please don't spam investors by sending dear sir emails. If you're going to send an email, please take the time and the energy and have the courtesy to please address the investor by his name and take the time and trouble to find out what his sweet spot is. You need to do the right pitch for the right person. And the purpose of the first email or the first contact or anything is, he's not going to sign a check. Please have realistic expectations. The purpose of the first contact is only to get permission to get a second meeting. Remember, you're just dating the investor. This is a long-term process. Not every investor is going to be right for you. And just because you've heard of Sequoia and Matrix and you're a startup doesn't mean they're going to give you money. You need to find investors who are relevant, who want to invest in guys like you. So the same early stage, who understand the industry you're in and who invest in early stage startups. When you're contacting potential investors, like I said, warm introductions work absolutely the best. That's called a mutual contact. Do your research, please. Contact the right investors, but please tailor your pitch to the right investor. Don't just spam and send the same generic pitch. It's very irritating. Be specific. Please have realistic expectations. We get lots of pitches all the time. And it's so much easier for us to say no. So we're just actually looking for excuses to say no. So if you have a typo on your pitch, if you misspell the name, if you've not bothered to do your homework, if your pitch is 6 months old and you're still sending the same pitch out, we're going to easily say no because we have 99 other pitches to look at. And those guys have taken the time and the trouble to actually send a well-crafted pitch. We're much more likely to say yes to them. No doesn't mean no forever. It just means not yet. And you do require to be patient and you do require to be persistent. But please learn to respect the investor. Learn to empathize and understand where he's coming from. Because the problem is if I say yes to a pitch, doesn't mean I'm going to sign a check. But that means I need to start doing my due diligence. And that takes a lot of time and energy. And therefore, obviously, for me, the most important thing in my life is my time and my reputation. And I want to conserve this. Startup accelerators can be great, provided they're good ones. There's so many bad ones, it's not even funny. And the reality, especially in the Indian startup ecosystem, is there are 100 bad accelerators for one good accelerator. And most accelerators are set up by guys who want to make money from entrepreneurs, don't want to help entrepreneurs. But a good startup accelerator, for example, let's say Y Combinator, just to use a name, it'll help you learn the trade so you understand all the jargon. It'll give you access to investors. And most importantly, give you this halo. Oh, yeah, wow, these guys have got funding from YC, so they must be good. Learning to pitch is extremely important. And this actually needs to become second nature for someone because you're going to be pitching all the time. You're pitching to your parents, you're pitching to your spouse, you're pitching to co-founders, employees, customers, investors all the time. Very, very simple to put a deck together. There's so many excellent templates available. What problem are you solving? Why is your solution right? Why it's right? So I don't really want to go into the details of all this stuff because you'll find enough information. But the most important thing is to engage with the investor. So start off with a bang. If you're making money, let him know, hey guys, we're making money. Start off with humor, start off with a story, start off with a provocative question, and this is likely to help. Two things. The pitch which you email to an investor is going to be very different from the pitch which you actually use when you're presenting face to face. It's not going to be one size fits all. And there's absolutely no reason to share proprietary information during a pitch, but you should share your pitch very, very liberally. Lots of common mistakes we make, and we're very happy when entrepreneurs make this mistake because it's very easy for us to say no. So some of them will ask for an NDA or a non-disclosure agreement, which is completely a sign that you're a rookie and you don't know what you're talking about. And no self-respecting investor will ever sign an NDA. Then lots of entrepreneurs will ask for valuation, what's called pre-money valuation, and they'll use what is called a discounted cash flow model, which again is completely work of fiction. None of those spreadsheets mean anything. Don't try to bluff. If you don't know something, it's perfectly okay. There's hundreds of things I don't know, and I keep on saying, I don't know, please educate me. There's nothing wrong with saying that. So say, I don't know, but I will get back to you. And please, when we're willing to engage and give you criticism, it means we think there's something of interest there, but please accept the criticism and the feedback respectfully. And if you only have an idea and you've not done anything to implement it, I'm not interested in talking to you. If you're going to show me hockey stick curves to your revenue, I mean, you're completely disconnected from reality. If you tell me you have no competition, that clearly means A, that you've not done your homework and you don't even understand where the competition is, or your idea is so bad that no one else is interested in doing it. If you don't have any skin in the game and you want to continue working in your job and you want an investor to fund you, there's something seriously wrong. And if you pepper your pitch with lots of buzzwords which you've read on your story or in media, whatever else, like AI, Bitcoin, blockchain, ML, and then just because you've done a Coursera course that makes you an expert and you don't think you can take us for a ride. We may not be as smart as you, but we're not idiots either. The one thing which actually scares investors is this entire idea of due diligence. The reason it scares investors is because it takes us a lot of time and trouble. And we're so happy when we find a mature entrepreneur understands how investors do due diligence. And the reason it scares entrepreneurs is because they have no idea what due diligence involves. All it involves is be honest with us. Don't lie to us. Don't bluff us. Just share whatever information. Remember, we're signing on as partners with you. This is a long-term journey. It's not 1 year or 2 years. This is, as Munav said, it's going to take at least 10 to 15 years. So treat us with respect. And if you try to hide something, we'll most certainly find it fairly quickly, and then you'll just end up with egg on your face. Due diligence is a process. There is always negotiation. Trust me about this. So just because you ask for $1 million doesn't mean we're going to give it to you. There is a due diligence checklist, so you should be aware of all this and keep it all ready. Ideally, share it all in what is called a deal room, which is available online, which shows you're well organized so that you don't have to waste time with each investor. It just becomes so much easier for you and for the investor. And then if everything goes well, hopefully you'll get a term sheet. But again, the term sheet is just the beginning. There's lots more steps you need to do. What do we look at? Fairly basic, simple stuff. Exactly the same stuff you would look at. It's not rocket science. For example, if a friend asked you, hey, I want some money to fund my startup, what would you ask him? So what market are you in? What's your business model, which is just a fancy word for how will you make money? What is your team? Have you been able to attract good people? And what progress have you made so far? And if you're saying sharing the same pitch deck for the last 2 years and you've not made any progress, that's a red flag. Funding is a critical issue. And the most important thing, of course, is how much money are you going to get and how much of your company are you going to give away. And that's where the negotiation comes in. And these are the two key parts, the valuation and the control. Lots of misconceptions. Lots of entrepreneurs are very scared. Oh, investors have all the aces. And that's true. We've done this more often. So we understand all the jargon. We understand all the fancy words like right of first refusal and pre-money valuation. We understand things like, what CCPS is, what tranches are milestones, and all this is foreign to you, and that's fine. But guys, you're young. You're clever guys. You can easily learn all this stuff without any problem at all. There's so much information. So buy at least 3 or 4 books, read about it, so none of this becomes completely foreign to you. Because if I use these words and you don't understand what these words are, that clearly means you have no business pitching to me. And please understand, we don't want to take over control of your company. We don't want to shaft you. It's not in our best long-term interests either. We have 50 other things to do. We want to fund an entrepreneur who understands how to run a business. So it's not enough if you're just an extremely smart techie. But if you don't understand things like unit economics, if you don't understand things like EBITDA and financial statements, it's going to be very hard for us to give you the money because we can't sit and teach you all this stuff. But the good news is you can learn it for yourself. Finally, you come to signing the term sheet. If you're lucky, you'll come to signing what is called a shareholder agreement. And again, there's lots of legalese, and I don't understand half these terms, but there are lots of standard templates, so it's easy to learn all this. But please, for heaven's sake, find a lawyer. Don't take shortcuts because yes, lawyers cost money, but this is money which is well invested. Importantly, find a startup-friendly lawyer. Startup-friendly lawyers won't shaft you. They will understand that you're a very immature business. They will do your best to help you to grow because it's only when you grow that they actually start making lots of money. And just because your uncle happens to be a divorce lawyer doesn't make him the right lawyer for you. This is basically what happens. You start off with 100% equity and you end up with maybe 17%. Though actually this slide is very misleading. What it does show is dilution. You should understand that you started, then your co-founder will take some and your first investors will take some and your accelerator will take some and your angels will take some. But the reason this is so misleading is because the slice of the pie keeps on getting bigger and bigger and bigger. So that even though you may own 17%, if you're owning 17% of a 300 crore company, that's far better than owning 100% of a 0 crore company. Why do investors like me invest? And this is something which people don't understand. And again, that's why you need to be empathetic. You need to understand what an investor is looking at. So for their own benefit, of course, what's in it for me? To make money, of course, that's what we say. But the reality is most angel investors never make money on startups. We end up losing money on startups. But that doesn't mean we're idiots. Why do we continue doing it? Because yes, it's fun to talk with young entrepreneurs who are out to change the world. You guys are full of energy and enthusiasm, and we get to learn a lot from you guys. And, I've been there, done that. I've been an IVF specialist for 35 years. It's still a lot of fun. Like I tell everyone, being an IVF specialist is more fun than being an angel investor. It's the best job in the world. You get women pregnant and you get paid for it. So I'm not complaining. But it's fun to look at other domains, learn some stuff. And the great thing, of course, is that I don't actually do the hard work myself. It's the entrepreneur doing it. But that's not the only reason we do it. We also do it for the sake of entrepreneurs because we remember how hard it was when we were young to start off. And we want to share our experience. We want to coach you. We want to guide you. We want to mentor you. And of course, finally, for the benefit of the world. And for me, this is extremely important. I have a soft corner for social impact startups, especially social impact edutech startups. And for lots of these, not only will we invest in them as far as equity, we will also give them grants, no questions asked, because we want you to improve the world. The way I look at it is our generation has messed up. Hopefully you guys will do a better job. So whom do I invest? I need to fall in love with the team. I know that sounds very irrational and very emotional, but like everyone says, you never back the horse, you always back the jockey. Most of the reasons for everything we do in life are emotional, non-logical reasons. So we use emotions first, and then we find logical reasons to back up our emotions. It's usually non-financial. God has been kind, made lots of money on the public markets. So I have extra money to invest in startups. I look for what I call an LOI or a learning on investment rather than a return on investment. If I become smarter about the world, thanks to the entrepreneur, I think that's worthwhile because the world is a fascinating place. I'm looking for entrepreneurs who have integrity. I don't want someone who's going to lie and cheat to me. If you're not doing well, that's fine. I understand that, but be honest about it. Maybe we can help. Someone who's curious, someone who wants to learn more, someone who understands that there is so much more to learn and you need to keep on evolving and adapting. And finally, someone who's humble, who has humility, who understands that he doesn't have all the answers. And no matter how smart you are, there's still lots more to learn. So we want someone who's willing to teach and willing to learn. But for me, the most important thing is to find someone who has paying customers. Because if you have paying customers, that obviously means you have product market fit, that you have something which makes sense, and you will use my money sensibly to help you to grow and to scale up. There is a difference between smart money and dumb money. And of course, all investors think our money is smart, but the truth is not all investors are the same. Please do your homework. Don't accept money from anyone who's willing to give you, and treat the money with respect. It's hard-earned money. Upar se nahi tapka hai. And raising funds means you're taking on lots of responsibility because you need to pay the investor back at some point. It's literally like this. It is a marriage, hopefully a happy marriage. Going to come to the end, last few pearls of wisdom. Beware of investors who don't respect your time. So if they give you an appointment and don't bother to turn up, that's a red flag. Means they obviously don't care or don't think you're important enough. Any investor who's only interested in how much return you can make them is just exceptionally naive and immature, because that clearly means he doesn't understand that most startups will fail and he shouldn't be burdening you. Ideally, you don't want to push sell your company. You want investors to come to you. And the right way of doing this is by posting frequently on social media, having a website, showing how much progress you're making, having customer testimonials, build in public. I think that's the secret magic sauce and the one thing Silicon Valley entrepreneurs do well. And I'm so ashamed of the fact that there's no reason why Indian entrepreneurs can't build in public. All you require to build in public is a smartphone, which all of us have. I don't know why you don't do it. Follow up till investors give you an answer, and it's fine if they say no, but just ask them why they rejected you and learn to negotiate. And don't be too rigid. And on the other hand, don't bend over backwards just because you want money. Remember, funding is a vanity metric. It's no validation that your business is going to be successful. Just because a VC gives you money doesn't mean anything. It just means that out of all the potential entrepreneurs who pitched him, you were the least bad. And therefore, obviously, he needs to use the money which he's got from his LPs, and therefore he needs to deploy it. The only validation is repeat paying satisfied customers. And all these vanity metrics like monthly active users and monthly downloads and how much user engagement, honestly, those are all vanity metrics. None of it means anything. The only thing I care about is cash in the bank. No's are not personal. We say no's to more people. Just because I said no today doesn't mean I won't say yes tomorrow. It's got to convince me. And if you keep on being persistent and showing me you made progress, I'll respect you a lot more. Please don't compare yourself with the unicorns. They're actually outliers. They're actually abnormal. You know, how many people have you actually met who have a horn in their forehead? It's most startups will never end up becoming unicorns. And investors are optional. You can always bootstrap. There's a big difference between angels and VCs. And it bothers me when entrepreneurs don't do their homework and don't bother to find out what the difference is. We invest personal money. VCs invest other people's money, which means obviously when it's personal money, I need to be much more frugal and careful about it. But we have different motivations. So we come in all shapes and sizes. Some people were happy to write checks liberally. Some people use a spray and pray. Some people will be part of an angel network to kind of dilute the risks. We're very hands-on. The most important question is, when did they sign their last check? Everyone on LinkedIn today calls themselves an angel investor. When you ask them, they signed one check for 1 lakh rupees 10 years ago. Anyone can call themselves an entrepreneur. Anyone can call themselves an angel investor. Anyone can call themselves a coach or a mentor, but just calling yourself that on LinkedIn doesn't make you one. And please interview their founders. Just like we do our due diligence on you, please do your due diligence on us. Ask the founder, does this guy micromanage? Does he keep on irritating you? Does he keep on asking you stupid questions, or does he add value? And VCs are very different because they have general partners, they have junior analysts. Those are the guys you'll end up talking to. But VCs are answerable to what are called LPs or limited partners, whom they get the money from, and they need to give the money back to them. And for VCs, it's a very long, drawn out, slow process, because it's always decisions by investment committees, because they're handling other people's money. They have a fiduciary responsibility. As an angel investor, I can sign checks very easily. The only person I need to answer to is my wife, and she's been married too long to me now to trouble me too much if I lose money. Most of us, you know all this. Ideally, what are we looking for? We're looking for a scalable business. We're looking for a better product and a huge market, and we're looking for the sweet spot. So that, for example, even if you have a better product and a huge market, but the growth is slow, then it's hard for you to be able to grow enough to be able to take external money. You'll mostly do great as a company which has a single person company, great cash flow business, and there's absolutely no reason to look down on it. Remember, investors are optional. And the whole point is that even if you have a great company which earns a lot of money for you, which keeps you helping you buy a Mercedes, that's great for you. But that doesn't mean that's right for an investor. Please understand that. So the business opportunity for an investor has to be very different from the business opportunity for an entrepreneur. This is the investment decision process. And the reason I'm bringing this up is it's a long drawn out process. You pitch and it usually takes anywhere from 6 months to 1 year to actually get money, because there's lots of deal flow, which VCs get, and they need to screen them, they need to do their due diligence. This is usually done at a very junior level, an analyst level. So don't get very excited when you get an email from Sequoia. Hey, I'm from Sequoia and we're interested in what you're doing. That's the job of the analyst. His job is to generate deal flow. He gets paid to actually send out emails to entrepreneurs and then find out what they're doing. And just because he wants to find out what you're doing, and just because he's listened to your pitch, and just because he's responded to your email, doesn't mean he's going to give you money, because he's not a decision maker. He's an extremely important person in the startup ecosystem, because he will be able to be your interface between you and the general partner and the VC, the guy who actually has the capability of signing the check. But the analyst simply has to present to the general partner. The general partner then has to convince the other guys in his investment committee, who they have to find out, will the limited partners accept this? Does this fit in within whatever our mandate is from the LPs? Then they get a term sheet. Then there's further negotiation. Your lawyer will say this is rubbish. Their lawyer will say this is crap. And then finally, if you're lucky, you will end up closing in this. Remember one thing, VCs usually end up doing only 5 to 10 investments. They have a lot of money, but remember, once you've signed the check, it takes us a lot of time and energy to follow up and to make sure that money is being deployed properly. And for us, that's important. And that's why we don't want to sign too many checks left, right, and center. We'd rather go deep rather than go broad. The bitter truth is most startups will fail. The even more bitter truth is no one knows which startups will fail. And that's why it's finally a numbers game for most VCs. And that's why it's what looks like a spray and pray approach, but it's usually not. So they will start off with a small cohort and they'll keep on doubling up on the winners. And the ones which fail, they will let them go. Why waste money after bad ones? So it's like the Gresham's law. It's important for you as a startup founder when your startup is failing and you care about this, because you have bills to pay and you have a reputation and people are going to say, God, what an idiot, he failed, and you have to pay your salaries. But at some point, an investor is going to be detached because he's seen lots of startups which has failed. And at the time when you need the most support from the investor is the time when you will not get that support, because from his point of view, he'd rather give more money to a successful startup, because that successful startup has earned the right to ask him for his money and you haven't. It's a numbers game, and usually what goes up has first gone down. That's fine. And the reality is all companies, once you raise money, will keep on needing more money. So you're always in fundraising mode. Be prepared for failure. Learn to be resilient. The most important thing is, even if the startup fails, you're not a failure. And it's a great journey. It'll teach you a lot about yourself. It'll teach you a lot about the world. But having said that, it's a lonely journey. There's lots of emotional angst, because when you're spending sleepless nights, who do you share all this? Oh God, the money hasn't come from the guy he promised. And then you keep on phoning him and he says, sorry, mujhko COVID hai. Main agle hafte tumko paisa dunga. Whereas the customers want their goods right now and you don't have any working capital and you're not sure how you're going to be able to do all this. And you've got salaries to pay and all you're living on is Maggie noodles because you can't afford anything else. And everyone thinks your life as an entrepreneur is so glamorous because they read all these fancy stories on all the startup media. But the reality is very different. It's very hard to convince your family that you want to chuck up your safe job. You need to find support. Other founders are the best source of support. Mentors and coaches can be extremely important, but they are completely different. Please don't get confused. Mentors are someone who do it because they think you're a smart guy and they think by mentoring you, they'll be able to help your progress. But mentors don't charge any money. Anyone who charges you money and calls yourself a mentor is a predator and a liar. Is taking advantage. And you don't believe me? Look up the Wikipedia entry for what a mentor means. People who charge you money are called consultants and coaches. And as long as they tell you upfront we're charging you money, I think that's absolutely fine. If they're adding value, you've got to decide if they're adding value. And that's purely fee for service. If they're not adding value, stop paying them. And most coaches and consultants will give you a free trial, maybe one call or maybe something. So you have a trial period and you can see whether the fit is right or not. Investors are completely different. The most value we add is by giving you a check. But you know what? We have skin in your game and we experience and we've seen lots of startups. So we're happy to act as coaches. We're happy to act as mentors if you think we add value. We don't want to force anything down your throat, but we've been there. And every advice we give you is completely free. There are incubators and accelerators, and like I said, there are good ones who will provide a lot of these services. But sadly, the reality is there are lots of parasites and predators in the startup ecosystem. Lots of guys who call themselves incubators, make lots of promises, promise to introduce you to lots of investors. All they will do is get free coffee and tea and get money from you, make all these fake promises, and then actually end up delivering nothing. So talk to friends and talk to their clients before you actually sign a single check. A good investor will never ask you for money, and neither will a good incubator or accelerator until they've proven they can deliver value. One simple thing you can do is set up an advisory board. This is not a board of directors. These are just friends, family members, uncles, senior guys who are happy to advise you. They get an ego kick out of this. Hey, I advised this particular startup and they're happy to help. And because they have a lifetime of experience, they'll be doing that. Remember one thing, the big problem with graduating from college is, now I have my degree, I know everything. And you only start learning, honestly, after you graduate. And curiosity is far more important. And this is the most important thing. You're always going to be learning. And that's the fun about being an entrepreneur. And that's the fun about being an angel investor. You make so many mistakes that you get to learn much faster than anyone else. What do you need to learn? You need to learn to sell. And even if you can't do anything else and you can sell, whether you're selling to customers, investors, co-founders, you'll be sorted. The most important way to sell is using emotional heartstrings and tugging on them by telling stories. You will obviously need to lead a team, and you don't need to learn all these skills yourself. You can find someone else who will complement your skills so you can do it together as a team. You need to get your hands dirty. You can't do this 30,000 foot view and have lots of ideas and expect someone else to implement them. You need to lead from the front. If you work hard, your team will work hard. You need to be patient. You need to work hard and persistently, because this is not a get rich quick scheme. Trust me about this. And the best way to learn a lot very quickly is to work in a startup, because in a startup, there is no job description. We're very happy for everyone to do everything because there's so much work to do and not enough employees. These are some of the books. All my presentations get uploaded, so they're all available on SlideShare. And I can't understand why everyone asks me, recommend one book. Why? Why not read 5 books? 5 books will give you 50 times the knowledge. And the reason for that is some of it will be repetitive. Some of it you won't understand in one book. Some of it needs to be reinforced when you read a second book, which tells you the same thing. And every good book is going to tell you the same thing again. So please invest in books. That's the one piece of advice. Don't take shortcuts. And websites are great and blogs are great and YouTube videos are great. But if someone has taken the time and trouble to write a book and edit it, it's often worth a lot. And don't get upset if you fail. All of us have failed all the time. It's the opportunity to start off all over again. And hopefully at some point, this is what you will look like, Superman Jr. And even if you do nothing else, this is one request I have. Please buy this book. The book is called Startup Funding. And a lot of what I've said has come from the book. And this is not the only book. Strongly encourage you. Lots of books, lots of wisdom, which you can learn from other people. So you don't need to make all the mistakes yourself. Okay, that's the end of my presentation. Now, how do I get back online? Okay, here I am. Can you see me?
Yeah, sir, we can see you.
Okay.
Okay, so as you've concluded the presentation with your talk, let's get to the Q&A part of this session.
So I hope you guys are reading the questions on the question and answer or the chat session, because often that's the best way of doing it. I'll happy to this thing. I think this is a big problem people have. What is your definition of a top startup? Your definition is one which has raised the most money or the one which has got the most press releases. And that's actually very flawed. Honestly, these are just vanity metrics. I think the top startup is the one which has the most delighted customers, the one where customers say good things. And it doesn't matter if you have 10 delighted customers or you have 100,000. Honestly, I'd have far more respect for a startup which has 10 delighted customers rather than 1,000 customers who say terrible things about the startup. So I have no respect for startups like Byju's, for example, because sure, they've got a lot of money and they raised a lot of money, but their customers hate them. and they say such nasty things about them because you're actually making money at your customer's expense. I don't think that's acceptable at all. And you're asking, how do companies raise funding and what do investors? I always tell people, this is not in my salary grade because I'm an angel investor. I'm a frugal angel investor. I invest in companies which add value to their customers' life. Please understand, a VC's life is not easy at all. Need to be a little empathetic. Suppose you're a VC and you're running $1 billion fund. This is money which is not your own money. You raised this money from rich limited partners, so you have to give this money back to them. At the end of 4 years, 5 years, 6 years, you have to keep on raising new funds. So VCs are also entrepreneurs. And that's why you need to generate returns. Now, if tomorrow you were a VC, you would rather give lots of money to a large company because their ability to multiply this is much faster. They'll be able to do it much quicker, even though you run the risk of their losing all that money. So for example, once you become big, you become too big to fail. And that's why it's much easier for all of them to use a herd mentality. And the reality is most VCs will follow a herd mentality and they'll follow each other because they're all langoti yars, they're all buddies. Okay, you invest in my startup, I'll invest in your startup. You give me a marked up valuation. These are all meaningless valuations. हाँ ठीक है, तुम मुझको $1 billion का valuation दे, they give me $10 million and I will invest in your startup and I'll give you a valuation of $2 billion. Honestly, all these are games which VCs play. Why do you care? Why do you even get involved or bothered about any of this stuff? This is all a distraction. These are all irrelevant stuff. This is all noise. This is not signal. None of this is useful for you running an early stage startup. My sincere advice is stop reading all this startup media because all it does is actually misleads you and distracts you and teaches you all the wrong thing because all these startup media companies run on press releases. And guess who pays for the press releases? It's the VCs who have the money to waste and the money to throw. No frugal investor like me who only cares about frugal entrepreneurs who want to delight their customers is ever going to waste money on press releases. The press releases are lies, plain and simple. I hope that answers your question. Yeah, so, asking questions like what do investors see in these companies is an irrelevant question. I wouldn't even bother. As an investor, when you invest, what returns do you expect? I'm a big boy. Right now, I expect my returns to be zero because, that's what is called the base rate. Now, let me put this in perspective for you. That doesn't mean that I'm throwing my money away. It doesn't mean I'm going to waste my money. But I realize that's the reality. Startups are complex adaptive systems. And no matter how good-hearted the entrepreneur is, no matter how good his intentions, no matter how hard he's willing to work, the future is unpredictable and uncertain. And no matter what, not everything is in his control. And I realize that. So when I invest in a startup, I can say I want this, that, but there's never any return we would ever put in the term sheet or in a shareholder agreement. So any investor who demands a return and who says things like, within 5 years, you need to give me an internal rate of return of 25%, is a bad investor in my book, because then he's effectively burdening you with a completely unrealistic expectations. So I'm happy with whatever return I get. But honestly, I'll tell you one thing straight away. I tell all my angel investor friends, because it's become very cool to become an angel investor. The only money you should invest in a startup is money you can afford to lose. And if it's money you can't afford to lose, you will spend sleepless nights. You will make your life hell and you will make the entrepreneur's life hell. And that's not good for the entrepreneur and definitely not good for the investor. Which are some of the favorite areas investors want to invest in nowadays? Terrible question. What do you care what investors want to do? You should only care about what you want to do. How does it matter because blockchain is fancy or anything else? Because what is hot today is not going to be hot 2 years down the road. You need to be skating to where the puck is going to be. Investors are a distraction, for heaven's sake. Focus only on your customers. And if you do a good job focusing on your customers today, it's quite likely that 3 years from now, an area which is not hot, but which you identified early will become hot after 3 years. And then investors will line up and say, please, mera paisa lo. That's a great position for an entrepreneur to be in. To what extent should an entrepreneur allow his share to dilute? Again, I think these are very generic questions. And a lot of it really depends on how much you think your company is worth. How much the entrepreneur thinks his company is worth means nothing. It's how much the investor thinks his company is worth. Because if the investor isn't willing to give you what you want, then all this again becomes vanity metrics and pointless. And there are fairly standard metrics, and usually we have a certain well-defined thing which we share on our website. Our website is www.malpaniventures.com, and we explain our thesis. We explain why we expect a certain dilution of 20% in the first startup funding round, so that we have a sufficient amount of the startup by the time you go to your second and your third and your fourth round, but we usually want to remain invested. How did book my show? How does any company survive any crisis? Today, this pandemic happens to be this crisis for all of us. Tomorrow, it will be some other crisis. Most startups are lurching from crisis to crisis every single day. And the only way to survive is to be agile and to be able to adapt and to be able to evolve and to listen to your customers. What do the customers want? And if you provide this, you'll survive. What is an exit strategy? Lots of angel investors will look for exit strategies. I honestly don't, because I understand all these are, paper pe kuch bhi likho, I will exit, I will get a merger and acquisition, I will file an IPO. Boss, I don't know what is going to happen next year. If you tell me what is going to happen after 3 years and 5 years, you're obviously smoking weed. Honestly, it's okay. It's all these are, let me tell you one thing. Interestingly, even we as investors ask you for all these projections and Excel spreadsheets and business models, but we all know they're fictional. They're all works of art. And the reason we ask you is if for nothing else, अच्छा इसको कम से कम समझता तो है कि नहीं how to create an Excel spreadsheet and how to create a business model, but we don't expect any of those business models to survive contact with reality. Plan are not important. Planning is important. So show us that you can plan and we're fine. Is it all right if you do a job? Of course. It's quite all right to do a startup while you're doing a job. Most startups have in real life started as side hustles done by people who are doing jobs. Let's be honest. If you're working for companies like Infosys or TCS, you have so much spare time. Half your life is on the bench, twiddling your thumbs, doing nothing, waiting for a customer. So that's the right time. Create your website, do a side hustle, do a freelance job on anything, see if you can earn money, see if you can be customer facing, and only do a startup if you've actually got that luxury of being able to prove to yourself, hey, this is easy, I can earn lots of money. And when you start earning money from your side hustle, which is more than the money you're earning from your full-time job, or at some point when you can't stand your manager anymore, that's the right time to start up. How do India's startup ecosystem differ? The cost of capital in India is horrendous. It's just so expensive. Money is expensive. When I say money is expensive, always remember, we always benchmark ourselves. And the way I look at it is, अगर मैं safe deposit में बैंक में डालूंगा fixed deposit में, so without any KitKat or headache or anything else, I'm going to get, let's say, 5% post-tax returns if I lock it up in a 5-year FD. That's what my benchmark is. Whereas in the US, banks actually charge you money for putting money in a fixed deposit. So their expectation is much less. So they're comparing themselves with a 0% return. So even if a startup gives them a little bit more, they're happy to give the money to the startup. Whereas for me, if I'm only getting 5% in a startup, whatever else it is, my benchmark is much higher than it is going to be in the US, simply because my cost of capital is much more. Also remember, understand an investor has lots of money and therefore he will allocate his assets. So I will definitely never put 100% of my money in a startup ecosystem. I will put most of it in, let's say, public markets where the returns are likely to be much higher and the risk is much less. So I will slot it up. And that's something else you need to remember. VCs are forced to put 100% of their money in the startup ecosystem because that's what their limited partners give them the money for. The job of a VC is to invest 100% in startups. The bichara uske paas koi choice nahi hai. Whereas if I find alternative investment opportunities, I will explore them. So you're not only competing against other startups, you're also competing against public markets. Remember that. So it's hard to get money. What are the main problems with AI startups? It's the main problems with all startups is that often you're a techie who's fallen in love with a shiny object. You've fallen in love with the solution. You've not been able to find the market. You've not been able to find giving you money. And the reality is most AI these days is not even AI. Most of it is commodity, if then. So just because you call it AI doesn't make it AI. Sorry. Often entrepreneurs run behind valuation. It's tempting. I don't blame you for running behind valuation. It's hard to say no to a $10 million check. If someone is giving you the money, I would say take it, honestly. You've got to get your brain screwed on right to be able to resist temptation. But that's true for resisting drugs. It's true for resisting smoking. It's true for resisting alcohol. This is another temptation. And hopefully by the time you're in college, you become big enough to be able to learn how to resist temptation. Are there any startups in our anti-portfolios? Tons of startups in our anti-portfolios, of course. Like I keep on telling you, and of course, I always tell people, I always tell entrepreneurs and my patients, the only stupid question is the one you don't ask. पूछने में क्या बिगड़ता है? Answer करूंगा वो मेरी मर्जी. And yes, we learn more from our failed startups. We learn more from the startups we didn't invest in. And that's absolutely fine. I don't understand VCs at all, and I've stopped trying to understand them. The way I look at it is I've got to focus on what I think is valuable. If VCs find interest, good for them. If they don't, that's fine. My company should be good enough to be able to survive irrespective of whether VCs find them interesting. And my thesis is that if my companies do a good job and generate money, they will automatically attract interest from VCs because every VC wants to make money. So I always tell people, the best way to get money from an investor is not to say, please भैया मुझे पैसा दो, मैंने IIT से पास किया है, मैंने फलाना डिकाना किया है, I'm so much smarter. The right way to get money from an investor is to double it for them or to promise to double it for them. Then there'll be a line of investors happy to give you money. And why do you have credibility for being able to show I can double it for you? Because, hey, look what I've already done in the last 5 years. I started off with 1 lakh. Today, my turnover is so much. I've taken zero money from people, and yet I've been able to manage. That's a lot of credibility. Apart from the money, what are the other parameters? Every investor says, हम तुमको coaching देते हैं, mentorship देते हैं, contacts देते हैं, सचमुच देते हैं कि नहीं, that's completely a different thing. The right thing actually is to ask other founders, those investors have given money in. Usually the most thing investors give are headaches. Sorry, I know that's politically incorrect because they always want to know. And when we ask you for MISs and we ask you for updates, it's not because we want to give you a headache. It's not because we're trying to micromanage you. We have 50 of our own headaches to manage. All we want to do is give you a 30,000 foot view from someone who has skin in the game, someone who will help you identify some of your shortcomings, what you're overlooking. I always tell any entrepreneur who comes to me, the value we add will be help you to get your governance in position, in place, so that if anyone is interested in investing in you, all your ducks are in order. Everything is being done. So it's easy for you to raise money from a bank, get a bank loan, or get money from a VC. And that's about it. Can you tell regarding customer funding? What depth? Customer funding means someone gives you money for the value you add to their life. So either you create a product or you create a service, you offer it to the customer, and the customer says, wow, this is brilliant. I'm happy to give you money, and you're sorted. So that's what customer funding is. What is a good way to see if your valuation is apt? I don't think there's any answer. And please don't get distracted by YC valuations or by Silicon Valley valuations. Those don't apply to the Indian startup ecosystem at all. It's like a McDonald's burger. Maybe a $1 in the US, but it's obviously not going to be the same thing in India at all. Your valuation is pretty much what an investor is going to give you. The best position to be in is get investors to compete amongst themselves to give you money. And the best way to do that is by showing them not where you've graduated from. Honestly, I don't even know where half my entrepreneurs, and I don't even care whether it's IIT or IIM or whatever else. What difference does it make to me? All I care about is their profit and loss statement, their cash flow statement. And honestly, you have a great cash flow statement, everything else is unimportant. What are my goals as an investor? That depends on what startup I'm investing in. In startups, some startups, my goal is purely financial. In others, it's purely social impact. Like you guys, I have multiple different hats. I'm never going to be one size fits all. And you need to be able to appreciate and respect that. The good thing is I'm very transparent about what my goals are, and I share my goals on my website. Is starting a startup during college? Yeah. Start it during school. Why are you waiting? You don't need permission from anyone else. All you require is a website. There are lots of these tools available. Get hold of a founder and start selling. Most basic books. There you go again. Why do you want just one book? How can one book give you answer all your questions? I don't think it can by definition. Each book is going to give you a different flavor. जब तुम खाना खाते हो तो तुम थाली से खाते हो, because it's not enough just to have a starter. You also want dessert. You also want a main course. Legal paperwork, please ask your lawyer. Hire a lawyer and your lawyer will answer these questions. How to avoid screw-ups? I don't think the WeWork founder thought of himself as a screw-up. And it's only after the event that we realize what is a screw-up and not a screw-up. What books will you suggest? I'll suggest exactly the same books I will do for everyone. Read as much as possible, because a book is the cheapest way of finding out the right information. Legal paperwork, again, like I said before, get hold of. So please pay a startup. What is the legal paperwork required? All you require is what the investor wants, and most investors will tell you exactly what they want. We want standard things like what your cap table is like, who's invested in you, have you filed your last year's income tax returns, what are your statements, have they been audited or not, all basic stuff. Do you stay away from sectors you don't know about? No. Actually, I love investing in sectors I don't know about, because that's how I learn more about the world. So I'm very happy to invest in stuff like blockchain, because part of the entrepreneur's job is to teach me and educate me about what I need to learn about areas I don't know anything about. How many books have I read? Guys, can you see that? That's just part of my library. I have lots more. And much more importantly, I have a lot more books on my Kindle. I don't know where my Kindle is. And I buy new books all the time. And I think the most important thing is not your library, it's what is your anti-library. All the 100 of books which are still left to read. And that's why I love getting up in the morning, because there's so much more to learn. And that's something you guys should be taking advantage of. Read a book, share the insights online. Read a book, share the insights on your website. Show people that you're a reader. People respect you if you're capable of learning and reading and sharing. Am I done?
Yeah, looks like it. So thank you so much, sir. You have answered really all of the questions. Now, out of all the sessions,
I saved you, Nikhil, from having to read them out, right? So I saved you so much time.
Yeah, and actually from all the sessions that we have covered, this was the only session where all of the questions were answered.
But that's partly because you should, allow the speaker to take that initiative and this thing. And in fact, I would strongly encourage you, please copy and paste these and send them to me, because all these are potentially posts I can tweet about. So this is exactly what works for me. If I can share it with 100 participants on the Excelsior webinar, why can't I share it with 15,000 followers on Twitter? And it's no additional work for me, because I've already answered the question. I just need to write it down. And what do I enjoy doing besides being an angel investor? I enjoy getting women pregnant. Sorry, I'm not a gigolo. I enjoy getting paid for it by their husbands. I happen to be an IVF specialist. And trust me, that's so gratifying, because you change an entire family's life by giving them a baby. So that still gives me a great kick.
So I guess that's it. So yeah, thank you so much, sir, for having.
Okay, thank you so much
being here.
So much for having me. It's always fun and always happy to answer more questions. Please go to our website. It's www.malpaniventures.com. Can you share it on the chat, please?
Yes, it's just malpaniventures.com.
And we also have okay, let me just do that. Malpani. And we also have another website called Startup Mentors, because we're trying to say all this should be digital, and the more they do it digitally, the easier it is. And honestly, the more you learn, the more you teach. How did you develop this habit of being outspoken? Yeah, I'm fortunate. I'm an old man now. I don't need to keep anyone happy except my wife. And by the grace of God, I'm well off. I don't need to raise money from limited partners or to keep anyone else happy. So life has been kind. And I always tell people, if at this day and age, in this stage in my life, if I don't learn to be politically incorrect, then when am I ever going to learn? So would like to. Is that okay?
Yeah, sure, sir. Guys, you can go check it out right now. I've posted a hyperlink in the chat, so you might as well go check it right now. And it was a great session overall. Thank you so much, sir.
Okay,
We
thank you
really
so much
loved
for
you.
having me, guys.
You talking, yeah.
Bye.
Thank you so much.